Picture this. It's Sunday night. You've told yourself again that this is the week you finally figure out your investments. So you open your brokerage app, stare at it for about 4 minutes, feel a wave of anxiety you can't quite explain, and close it. Then you spend 45 minutes watching someone else's financial highlight reel on Instagram and go to bed feeling vaguely guilty. Sound familiar? Here's the thing that guilt is costing you, not just emotionally, mathematically. And I'm going to show you exactly how much in just a second. Look, we've been sold this idea that successful investing requires constant attention, that you need to be watching the markets every day, reading earnings reports, listening to podcasts on 2x speed, and obsessing over your portfolio allocation. The finance industry has a vested interest in making you feel like managing money is complicated, because complicated means you need them. But here's what most people don't realize: the data doesn't support the hustle at all. A 2023 study out of Dalbar, the financial research firm, found that the average equity fund investor earned just 6.81% annually over a 30-year period. The S&P 500, it returned 10.25% over the same stretch. That gap, nearly 4% per year, isn't because those investors were lazy. It's because they were too active. They were checking, reacting, tweaking, panicking, and optimizing their way into underperformance. The investors who did better, they were mostly the ones who got out of their own way. Let me give you some real numbers here, because this is where it gets really interesting. Say you're 30 years old and you invest $500 a month into a broad index fund, something like a total market fund, averaging 9% annually. If you do nothing but set that up and check it once a month for about an hour, by the time you're 65, you got just over $1.1 million. Now say you're the active version of yourself, same $500 a month, but you're constantly moving money around, chasing returns, getting spooked by headlines, pulling out during corrections, and jumping back in after the recovery. Studies show that behavior gap I mentioned, that 4% drag, would leave you with roughly $500,000 instead. You worked harder, you stressed more, you spent probably 20 hours a month instead of 1, and you ended up with $40,000 less. That's not a small rounding error. That's a beach house. That's your kid's college. That's the difference between retiring at 60 and retiring at 68. Now you might be thinking, okay, Nick, but I can't just ignore my money. What if the market crashes? And I love that objection because it gets right to the psychological core of this. The reason we overmanage our investments isn't because we're dumb. It's because our brains are wired to do something when we perceive a threat. It's the same instinct that kept our ancestors alive when a predator showed up. The problem is, the stock market isn't a predator, and doing something in a downturn almost always means selling low and missing the recovery. Think of it like this. Imagine you owned a rental property. Every single day, a stranger knocked on your door and offered you a different price for it. Some days they're euphoric and offer 20% above what you paid. Other days they're panicked and offer 30% below market value. Would you sell your house every time the guy showed up with a low offer? Of course not. But that's exactly what most people do with their portfolio. The 1 hour a month investor understands that the price fluctuation is not the asset. The asset is the underlying businesses you own. And those businesses don't change in value because the news cycle had a bad week. So what does this actually look like in practice? Because I don't want to just throw philosophy at you. I want you to walk away with the system. Here's what your 1 hour a month looks like. Week 1 of the month, 20 minutes. You contribute your scheduled investment amount. You don't look at your returns. You don't look at what the market did. You make your contribution and you close the app. That's it. If you automated this, which you absolutely should, you don't even need the 20 minutes. You're done in 2 mid-month 20 minutes. This is your check-in without touching session. You open the account, you look at your overall picture, you confirm everything looks normal, no unauthorized transactions, no technical errors, and you close it. You are explicitly not allowed to make any changes during the session. None. This session is observation only. End of month 20 minutes. This is your one decision window. If anything genuinely warrants a change, maybe you got a raise and want to increase contributions. Maybe your life situation changed. This is when you do it. One decision window per month. That's your entire permission structure. Here's what most people don't realize. That structure isn't just efficient. It's protective. It removes the moment-to-moment emotional decision-making that destroys long-term returns. You're not ignoring your money. You're governing it with discipline instead of anxiety. I want to address something, though, because some of you are going to ask, but Nick, what about the initial setup? Doesn't that take more than an hour? Yes. The setup phase takes longer. I'm not going to pretend otherwise. Getting your accounts right, choosing your funds, setting up automatic contributions that might take you 3 to 5 hours total across a couple of weekends. But you do that once, and then you're in the system. Think of it like installing a dishwasher. Painful to set up. After that, You load it and press a button. The 3 things you need to set up correctly: first, your account structure. Max your tax-advantaged accounts first. Think of your NN registered accounts and Provident Fund structures. In the US, that's your 41K match, then your Roth IRA, then taxable brokerage. Wherever you are, tax efficiency is free return. Don't leave it on the table. Second, your fund selection. You don't need 12 funds. Most people are well served by 2 or 3. A broad market index, maybe an international index, and, if you're older, a bond component. Low expense ratios, we're talking under 0.2%. That's it. Not glamorous, incredibly effective. Third, automation. Set up automatic contributions on payday. Before the money sits in your checking account long enough to feel spendable. Pay yourself first isn't just a motivational poster, it's a behavioral architecture hack. When the decision is automatic, your emotional brain never gets a vote. This is where it gets really interesting, and I want you to sit with this for a second. The investors who consistently outperform, they're not the ones with the most sophisticated strategy, according to a famous internal analysis from Fidelity, and this story has been corroborated so many times, it's practically folklore. The best performing accounts belong to people who had either forgotten they had the account or died. I know that sounds morbid, but think about what it actually tells you. The absence of interference is the strategy. Your portfolio's enemy isn't a market downturn. Your portfolio's enemy is you at 11 p.m. after a scary headline with your phone in your hand. The 1 hour a month system isn't about being passive. It's about being intentional with your attention. You're not checking out. You're choosing not to be baited into reaction. Look, I know this sounds too simple. Our brains resist it because we've been conditioned to believe that effort equals results, that working harder on something always produces better outcomes. But investing isn't construction. It's not farming. It's closer to meditation. The goal is to do less, not more, until less becomes a disciplined practice rather than neglect. You have 1 hour this month. That's all this asks of you. Set up your automation. Make your contribution. Check in without touching. Review at the end of the month. Do that for 30 years and let compounding do what compounding has always done: quietly, patiently, relentlessly turn consistent small actions into life-changing wealth. The people who will still be panicking and overmanaging their portfolios in a decade, they'll look up and wonder why you're so far ahead. Now you know why. If you want me to walk through the exact fund setup and account structure step by step, that's the next video. I'll link it right here. And if this one helped you, share it with one person who's been staring at their investment app and closing it without doing anything. That person needs this more than they know.